Welcome to the Real Estate Power Play Podcast, your launch pad for skyrocketing success in real estate investing. I'm your host, Gabe Rodarte, alongside Mark Monroe. We're ready to bring you transformative stories, groundbreaking strategies, and the insider secrets of real estate giants. Get ready to accelerate your investment journey and become a true power player in the world of real estate.
Okay, how's everybody doing? Welcome to another episode of Real Estate Power Play. I am your host this week, Mark Monroe, and I am super excited to have Nick on. I know we finally chatted. We've been doing some business there for quite some time, and
Yep.
thank you so much. So, Nick, why don't you introduce yourself? Tell us who you are and what you guys do.
Yeah. So first of all, thank you so much for having me on, Mark. A pleasure to see you as always. I work with Safeguard Advisors. We're a company that creates self-directed, checkbook controlled retirement plans for investors who want to invest their retirement dollars. So their 401ks, their IRAs into assets that you wouldn't be able to invest them in if you have them at, your traditional custodians like Schwab or with a plan administrator. So that's what we do. And we talk to investors from all over the country and help them put their retirement dollars to work and really unlock their retirement to the assets they know and love.
Yeah, it's funny that you said that Schwab, and because that's where I was at Schwab, and that's when we moved everything out of there over to you guys, and you guys got us
Yeah.
all set up. So yeah, it's excited. So I highly recommend it. We have we already use a checkbook, and we already have it already put in the work for us, so it's doing really well.
That's
So
awesome.
yeah, so why don't you talk a little bit like about it? What's the pros and cons, and like what's the really advantages? Why would somebody want to do it versus, everybody may not know what a syndication is. So why don't we talk a little bit about that? Like I've been involved in some syndication deals, and so why don't you kind of dive in and just kind of give everybody a little bit of, checkbook IRA or even solo 401k 101, if you
Yeah.
will.
Yeah. I think the first thing when people are, they start driving down this road of self-directed, and that's really just the basic understanding that, oh, I'm taking my retirement dollars and I'm putting that not into your conventional stocks, bonds, mutual funds. I'm putting this into alternative assets. So they start down that road and then they get to this fork. And I think a lot of people don't understand that there are really two roads you can take, two paths you can take when you're considering self-directing your IRA. One of those paths I would call direct custody. So direct custody is really when you have or you're working with a self-directed custodian who will allow you to invest in, alternative assets, but they're going to directly custody that asset, right? They're going to directly hold it. You're not going to be the one really, making those investments yourself. That custodian is going to be doing everything on your behalf, and you're really going to pay for that. So that's path A, right? But also where this road splits off, you can take path B, which is what we do, which is checkbook control, right? Which instead of having a custodian who is holding these alternative assets for you, like real estate, midterm rentals, any of these, whatever it is, pick your flavor. You have a specialized entity, an LLC or a trust that is owned by the IRA that you get to be the primary authority on. So essentially, you're the one in the driver's seat and you get to take control. You get to make the transactions without going to a custodian and saying, hey, Mr. Custodian, pretty please, I'd like to invest in this property. And they say, yeah, or no, we're not going to do that. And if they do it, that's great. We have a one-time, $150 processing fee. We're going to transfer the funds. And the way I really look at it, just to break it down, I'm all about analogies. That really helps me learn. So when I'm thinking about this as an analogy, it's like direct custody, that path is kind of like you're ordering an Uber, right? You're paying somebody to either approve to take you somewhere, to get you to a place, and it's really up to them to choose if they want to drive you there. You're going to pay them a little bit extra to come and pick you up. And it's really up to them to get you to that location safely, right? And then checkbook control, I really look at that as, you're purchasing your own vehicle. You have your own car and you want to go to, you want to go to Walmart, you want to go to Target, and you take the keys and you go in the car, and really all you have to worry about is the gas money and getting yourself there safely. And that's really, when you're looking at self-directed IRAs, those are really the two choices you have. Do I want it to be more, hands off? A custodian takes care of it for me. They keep me compliant, but I pay maybe a little bit more for them to do that for me. Or do I have my own vehicle that I can drive anytime I want, and I just understand the rules of the road to keep me safe as I'm utilizing this this structure?
That's great. Yeah, it's and I think the 150 processing fee is pretty cheap. I've heard some of companies up to $700 to do that whole entire
I'm
process.
being generous, yeah, and I don't know exactly what the processes is, but yeah, the direct custody model, like I said, hands off, definitely more fee driven. That's how they're going to make their money. On the checkbook control side, it's really about the direct control, the autonomy, that freedom to invest on your own, but not without its caveats, right? Where you're the one in the driver's seat, right? If you don't know the rules of the road, you can definitely get yourself into some serious trouble.
Yeah. And so a lot of people are not even aware that, if they have an IRA or even setting up a solar, and we can kind of get into that briefly here, but most of the people just, they have the 401k, then they end up leaving that company, their job, and they have to roll it over to an IRA, and then they just let whoever that IRA is manage the money, and typically it's all in the stocks and mutual funds or whatever. A lot of people are not even aware of these other alternative assets that they can invest in through this type of strategy. Is that correct?
Yeah, that's what you find. I mean, when I learned about it, I was, I was semi-aware of retirement. I was semi-aware of different strategies people have, but it came as a shock to me. And the more I learn about it and the more I talk about it, the more I realize it's definitely more mainstream than it was, but it's still this, I feel like, this elusive mystery to some people. But yeah, like you said, it's something that can allow you to invest in the assets that you already know how to generate wealth with. Like a lot of your listeners, and you talk about these amazing seller financing strategies. It's the same strategies, it's the same strategies you've been using, whether that's your midterm, short-term rentals, whether you're fix and flipping, whatever your strategy is, you're really just taking that wealth generating, that machine into, your retirement, and making money that way. And the nice thing is, the IRS really, they don't have this like neat list of like, these are all the things you can invest in, right? They really only have a list of things you can't invest in, and it's a really short list. It's like 3 things. So you cannot invest in life insurance policies or contract with your retirement funds, period. It's completely off the table. You can't invest in anything that the IRS deems a collectible. It's things like stamps, collectible cars. It's a funny thing, people back in the day, because you could always invest, your retirement funds into all, alternative assets. So a lot of people were investing into, wine collections and, collectible cars. And the IRS was like, I don't know if you should be able to drive or drink your retirement. So maybe we should put the kibosh on that. So you can't invest in anything that they deem as collectibles. And then the last thing is really just subchapter S corporation stock, or just S corp stock. Beyond those 3 restrictions, it's anything else is on the table, right? Real estate's going to be the most popular. I'd say like 80% of our clients are investing in real estate. But we've had people come to us investing in music rights with their retirement, apiaries, which I didn't know was a bee farm until somebody told me that they were going to be doing that. So it's really taking your knowledge, taking your skills, and putting it to work in retirement.
And I like it. So what's the benefit of, like, for example, using like a solar 401k or an IRA and buying an asset, or fix and flip? That's another big one that people tend to use. So what's the benefit why they want to do that inside of the whatever owned by the retirement, if you will? Um, so I like the trust or an LLC. What's the benefit of that from the tax point of view?
Yeah, so these, I won't say as everybody knows, but as most people know, these IRA plans are tax sheltered accounts, right? So if you have a traditional IRA, you're deferring your taxes, right? You're saying, I'll put this money in this IRA account and I'll pay the taxes later when I take it out. or it's a post-tax account, it's Roth, and you're essentially growing your retirement funds tax-free. So whatever wealth you generate, through your real estate strategies, that's all continuing to grow. And when you take it out at retirement age, it's completely tax-free. So that's I like to think of that as the cherry on top. I mean, you're already getting to jump into this machine and bet on yourself rather than bet on the public markets and Wall Street, the conventional assets. But then on top of that, you're doing it all within the bounds of a tax sheltered account, which is just incredible that you can generate that type of wealth. And at the end of the day, say, sorry, Uncle Sam, like this is a Roth IRA. You're not getting a dime of this.
Yep. And you can also like the fix and flip. So when you do a fix and you flip and you profit, it in a sense that's tax free because you're keeping it inside the retirement. Is that correct? Versus paying capital gains on that flip.
Yeah. So, and that goes for really any income that's coming into the plan, right? Let's say you're doing midterm or short-term rentals, or any type of rentals. You're getting, that monthly rent check that's coming in. That rent is coming into a tax sheltered account as well. So yeah, like you said, that's completely tax sheltered as well. You're not looking at the capital gains of this big exit from this property. You're not looking at capital gains or being taxed on income that you're generating or the cash flow that you have with this asset. You like I said, I mean, this is considering that it is a Roth IRA, but that's all tax free cash flow and growth.
Yeah, I'm actually going to Nashville to speak at the seller financing note conference for notes.
Oh, nice.
So I know a lot of investors buy notes through their IRA or through their retirement fund. You want to talk a little bit about that?
Yeah, we see people investing in notes, tax liens, deeds of trust. I like to think of those as the more real estate adjacent investments, but that's something that people definitely do. I'm not an expert in what that process looks like, but it's pretty simple. It's with the structures that we have, you're really just having your IRA owned entity, that specialized entity we talked about. Again, that's going to be an IRA LLC or an IRA trust. And that trust is going to be the one that owns that note or purchases that note. So, a pretty important thing with self-directed IRAs is that this is not fund that you are using personally or benefiting from personally. This is all retirement funds growing for the benefit of your future self. So yeah, when it comes to investing in notes, tax liens, deeds, that's not something that you're personally going to, a county auction and showing up with your own personal checkbook. You have a checkbook from your self-directed IRA, LLC, or trust, and that's where that money's coming from.
Nice. Very nice. Yep. We're doing that on, like I said, we've used the whole setup and we're investing in doing a small land development project, affordability. So bought the land and now we're putting manufactured homes on it and be able to sell it, off. And it's a pretty good turnaround time I know is there. So, and all the profit, all the income that we make from it stays inside there, so we don't get the tax on it. So it works really well. I mean, we like it, and it just works. Just in general, doing these type of projects.
Yeah, and I will say too, when you are looking at doing tax liens and deeds, I know that can be at times a very quick investment timeline, right? Where you need access to funds and you do need that autonomy. And going back to those two models that we were talking about, it is important to consider what your investment timeline is, how much flexibility do you need? Because if you are in that direct custody route and you need a check yesterday for an auction that you're going to, good luck getting a check from that direct custody custodian. Of course, you can plan ahead, but that's not always something you can do. So checkbook control does work for a lot of people who do need those quicker timelines, that quicker turnaround. And like I said, that autonomy to know that at any time I can whip out that IRA LLC checkbook and I can write a check, or I can have that check. I know in a lot of times it had to be guaranteed funds. So you can get that guaranteed funds check for that auction or whatever it may be.
Yeah. I had a buddy, Kenny, he buys a lot of stuff through auction.com. And he, in the beginning, when he started doing this, he lost a few deals because he didn't have the access quick enough, he got beat out. And now he does the same thing. He does the open checkbook, and every time he picks up a property, he just really quick. Because you have to be able to move, like you said, you have to move quickly on some of these projects.
Yeah, and it would be terrible to have, this golden opportunity land in your lap, and the processing delays of a custodian is going to be the reason you lose a deal. It would be a terrible thing.
Yeah, I've seen one where a few years back, we purchased a mobile home park, and some of the
Mhm.
people, I mean, it took like 2 to 3 weeks for their capital to come in. Like it held us
Yeah.
up because of that. You know,
Yeah, and that's why a lot of the times, when people are looking to set up, I'll ask them. I'll say, "Hey, do you have any deals, on the horizon? Do you have any, timelines that we need to be mindful of?" Because the setup process will take a while, because you are setting up an LLC, you are setting up a trust, creating plan documents, filing for an EIN. But once you get the actual structure in place and you get the money transferred in, that's really when you have the speed. So we will have people who come through and they'll put it off. They'll say, "No, I don't have anything lined up yet, so I won't set it up." And then they'll come to me, a month later and say, "Hey, I've identified this investment opportunity. I need my plan set up tomorrow." And the reality is, not only setting up the structure, but rolling over the funds, from your other custodian, that's a 2 to 3, maybe 4 week process, depending on how good your custodian is.
yeah.
So yeah, definitely something to consider,
I
and
wasn't
definitely
even
something
thinking
not
about
to
that with you
procrastinate.
all. I wasn't even thinking about that with you all, but it was through a custodian because we had to provide all the paperwork to the
Mm.
custodian, and it took a little bit of a process on that one. So if they had the open checkbook, they could have easily had that over in a couple of days on that.
Oh, for sure. Yeah.
Cool. Let me let me ask you a question. Maybe this is not the right conversation. Maybe I don't even know. So, have you heard? How are you familiar are you with what's called the backdoor Roth? Are you familiar with that at
Yeah.
all?
Yeah, it's just amazing strategy that will allow people who are too rich for a Roth IRA, um, and will allow them to be able to actually contribute and get funds into a Roth IRA. Yeah, it's an amazing structure. I mean, we're not tax or legal advisors in any type of way, but
Right.
we've definitely seen people take advantage of this opportunity, because what essentially happens is, once you hit a certain income level, and it's different based on if you file individually, if you file jointly, but there's this number that you can reach where the IRS says you cannot contribute directly to a Roth IRA. Sorry, you do not pass go, do not collect $200. You're making too much money. We don't want you to get that tax-free
And
growth.
what is that roughly? Is that like 7,500 nowadays or
I don't
8,000?
again, I don't know what that is this year.
I
I'm
have
not a
to look
tax
it up.
advisor. Yeah,
Yeah, it's
I could
okay, but
definitely look it up, but
don't worry about it. But it's just a generic. I think it's somewhere. But go
the
ahead. And then what happens from
yeah,
there?
so what happens with a lot of people is they look at that and they say, "Oh, I can't open a Roth IRA. I'm too rich to open a Roth IRA." But that's not what the IRS said. They said that you cannot contribute directly to a Roth IRA. You can still have an account, but you cannot contribute directly to it. So what the backdoor Roth strategy is simply setting up a traditional IRA, which is pre-tax, and contributing your $7,000 to that traditional IRA, and then doing an IRA conversion from your traditional IRA to your Roth IRA, which at a really basic level just involves you paying off the taxes on those funds and then having them being transferred or rolled over into the Roth IRA. So a lot of people miss out on that because, again, they'll say, "Oh, I can't, I can't have a Roth IRA. I make too much money." And it's just, I think it's a pretty unfortunate misconception that people end up having.
Yeah, I heard a lot of like people that have that capital, but they're also saying it's a good time, like if you're showing, like if you make a lot of money, but if you're showing a loss, that's kind of a good time to kind of do that, because that helps with your tax. Again, I'm not a CPA and you're not as well, but
Hmm.
we're just talking in general about, if you guys never heard of it, it's called the Backdoor IRA. So just do some research on it. But that was pretty, just want to kind of briefly talk about that because I'm sure you probably see some of that stuff.
We see a lot of people doing that for sure, and that's something that you can definitely do within a Roth IRA. I'll even say this, with assets in an IRA. So if you have, let's say, an IRA LLC, you have checkbook control, this structure, and that Checkbook Control LLC owns a property, right? In a traditional IRA. So that's a traditional IRA owned property. Let's say, like you said, the stars aligned, you talk to your tax advisor, and it's a good time, or it's a good strategy for you to convert that property or a portion of that property to Roth IRA. You can also convert assets. Not everybody's going to want to liquidate, a property that they own, but what you can do is you can do an in-kind, which basically means you're just keeping the property intact, an in-kind conversion, where you're taking that, that property, the value of that property, paying off the taxes, and then for the remainder of your, your retirement life cycle, that property is now going to be growing tax and penalty free.
Nice. Very nice. I like
Yeah.
that. So what if they have a property that's not inside of the retirement now? Is there a way to kind of be able to get that in there?
That's a great question. And I say that because a lot of people who are looking to just get into this, that's exactly where their mind, that's the first thing their mind goes to. They say, oh, I have five properties that I own right now. How can I get these into a self-directed IRA? And I mean, the unfortunate answer is you can't. And that really goes back to one of the biggest rules with self-directed IRAs, prohibited transactions and disqualified persons. Basically, a prohibited transaction occurs when you have a disqualified person who is transacting with, benefiting with the plan. You are the first, the account holder yourself, you are the first and most important disqualified person to remember. So yeah, when you have a property that you own personally as a disqualified person, transferring that into the plan would be immediately a prohibited transaction, unfortunately. But that's something that a lot of people do gravitate towards for whatever reason.
Well, let's stay on this topic for a second. What if they, even if they have that property in the LLC, is that considered, the IRS still looks at it the same way?
Yeah, because what you're really looking at is who is the beneficial owner of that LLC. Is that the beneficial owner of that LLC a disqualified person? And just to cover disqualified persons in more detail, like I said, it's first and foremost you as the account holder are unfortunately disqualified. It's your spouse, your partner, and then it's any lineal ascendants or lineal descendants, which is the IRS's really fancy way of just saying anybody directly above you or below you on the family tree. So grandparents, parents, kids, grandchildren, and their spouses, obviously, are all disqualified. So a lot of people will just say, oh yeah, disqualified persons. I know that. All my immediate family, everybody I'm close to. I'm like, well, hold on a second, because you've got brothers, sisters, nieces, nephews, aunts, uncles, and cousins who all are, close relationships that many people have that aren't disqualified from your plan. So I think that's an important thing to point out, is that it's not just this broad sweeping term of, your general relatives. It's direct family line, right? So a lot of people do miss that when they're thinking about who is disqualified, who can I invest with, whose property can I purchase.
Got it. Okay. So you've mentioned, we talked about the backdoor IRA, you talked about the incline. Is there any type of another good nugget that we're not aware of that is it like that you can do with these type of instruments?
Yeah. So with the I will say with real estate specifically, there's something referred to as UBIT, unrelated business income tax. This is basically tax that your IRA owes when it earns interest from an active business, right? There's a specific type of UBIT, and it's called UDFI. I believe that's unrelated debt financed income. Again, just a type of UBIT, but what it basically means is when your IRA borrows money or uses leverage to buy a property, the portion of the income that's attributable to the borrowed money becomes taxable. So like with a working example, if your IRA bought a rental for like $200K and puts down $100K of its own money, and it borrows the rest of the $100K, 50% of that property is quote unquote debt financed. So roughly 50% of that net rental income is subject to what's called UDFI, that unrelated debt finance income. So as you pay down the loan, that taxable portion does shrink. But something to consider, because a lot of people don't even realize that you can use leverage when you are purchasing IRA properties. Not everybody has, 200 to 500K sitting in their retirement accounts, and they think, oh, like it'd be nice to invest into real estate, but I just don't have the capital within my retirement accounts to be able to make that happen. And they're totally missing the opportunity to utilize leverage with their IRA, and get into some properties that they otherwise really couldn't acquire. And the one thing is, when you are using leverage with the self-directed IRA, you can't just use, a traditional loan, right? Because with a traditional loan, you're typically personally guaranteeing something, right, as collateral for the loan. And as a disqualified person, the IRS says, no, a disqualified person is not going to put up collateral for an IRA-owned asset. So that's off the table. So you have to do a specific type of loan, use a specific type of leverage called a non-recourse loan. And that's the non-recourse loan is really just a loan where the only collateral that you're putting up for that loan is the property that you're purchasing itself. Something that's a handful of lenders will be able to do. Safeguard Advisors is actually owned by a bank, Solera National Bank, that has a fantastic non-recourse lending program, and they just launched they have this amazing non-recourse lending portal now where you can self-qualify your deals. They have I believe it's a calculator where you can plug in your specific loan information to see, what type of offers you could get. So that is something I think a lot of people will overlook, is stretching your dollar a bit further than maybe you could if you don't have, the capital in your retirement account to be able to get into some bigger assets.
Nice. So back to what you're saying before. So if you do take a loan out and you're leveraging, were you just talking about a loophole, or not a loophole, but a way where you don't have to pay those taxes? Is that what you were referring to before?
So it's just something to be aware of, right? Because a lot of people will be aware of this non-recourse leverage strategy, and they'll forget that that means that they will owe some taxes. I think a big misconception that people will have is they'll look at a deal, they'll say, oh, I need to use, some type of leverage. It'd have to be non-recourse. And then the moment they figure out, oh, that's taxable, they're like, oh, just kidding. I don't want to do this anymore. UBIT ends up kind of killing the deal, which I think is totally unnecessary, because a lot of the times when you think about the net income that you would be gaining from an asset that you otherwise wouldn't be able to acquire, that net income, even with the taxes, ends up being more than you would get with a property that you could afford with just your capital, right? So I'd say, yeah, UDFI, it definitely sucks. You never want to pay taxes in a tax sheltered setting, but I don't think you should always let that be, something that kills the deal or stops you from looking into the actual numbers and seeing if it's something that would in the, at the end of the day, work for you.
Okay. I like that. So those are some great golden nuggets there. So we talked about 3 of them that's really good strategies like inside of it. Is there anything else, or is that pretty much that you're aware of?
Yeah, we really haven't. I mean, we've covered a lot of the things on the self-directed IRA side. I think the one thing I would want to touch on, and I think you know all about this, just from experience, is the solo 401k. And a solo 401k is another type of self-directed retirement plan that also has checkbook control, like we talked about, but it's a plan that's specifically created for self-employed individuals. And what that means is that you, as the owner of your self-employment business, you can sponsor your own retirement plan, and you can contribute to that plan with the earned income from your business activity. And it ends up being about, the contribution limits for a solo 401k end up being 10 times higher, around about 10 times higher than you'd be able to contribute to an IRA. I believe this year you're looking at being able to contribute a maximum of $72,000 into a solo 401k. That's a maximum contribution limit. So the solo 401k is, a really powerful opportunity for people with self-employment activity to be able to pump a lot of their money into retirement. And if you're not worried, even another thing, it's a great way to be able to defer taxes. Being able to, contribute up to $72,000 as, a pre-tax contribution and defer that in taxes is a powerful, tax strategy that a lot of people, I think, would love to take advantage of. And then at the end of the day, you get to turn around and you get to invest that into real estate. You get to invest that into crypto or, these alternative assets that you may have the strategies to unlock real, wealth building opportunities.
No, that's great. And also, from what I understand, retirement plans, if you accidentally back up and you injured somebody, they're protected. Aren't they asset protected as well?
Yeah, again, I'm not a legal professional in any way, but just generally speaking, when you're looking at assets owned by a retirement plan, the what you're really liable for, or what you're typically looking at being called into question with any trouble legally is the assets within the plan itself. So if you, for example, if you have an IRA LLC, you have 5 properties within that LLC, and one of the tenants in one of the properties sues you for slipping and falling on the driveway that you didn't shovel, whatever it is, that property obviously is liable for any type of legal action. And then the other properties within that plan generally are also called into question. But any of your personal assets, I believe, are generally protected. But what a lot of people will do is they'll set up some type of series LLC structure where their IRA-owned LLC will in turn own its own, general purpose LLC. And they'll create a separate LLC for each property, hold them all separately in their own LLC. And what that does is it essentially, spreads the liability between, 4 or 5 different entities so that, LLC A holding property A does, come into some, does catch some legal heat. The other properties and the other LLCs will generally be protected. So some different things you can do, but if you're just putting all the properties in one LLC that's owned by the IRA, generally speaking, all those are going to be liable for any legal action.
Nice. Wow, there's a lot that we just covered. That's so is there a question that I didn't ask that I should have asked?
I think you've asked some really great questions. I think really where your expertise comes into this is how does seller financing, as this niche of its own plug into self-directed IRAs and this whole different world. I think that's something that a lot of your audience would really benefit from is, you have all this knowledge in this space, and with the knowledge that I have of the self-directed retirement space, I think there's these two niches that can really come together and be mutually beneficial, for people who are looking to generate wealth in real estate.
No, I like it. It's so what we'll do is below wherever you're watching this or listening to us, we'll have a link below where you can go ahead and book a call, schedule a call on the calendar with you. Is that how you want to handle this? The best way of going about it?
Yeah. If you have questions, I know we covered a lot, and I don't think any normal human could retain all of the information that we talked about today. So if you do have any questions, or you just want to, brush up on the information that we talked about today, or you're just interested and want to learn more, feel free to grab some time on my calendar. It's the easiest way to get a hold of me. I end up being on the phone a lot with different clients who are interested. So book a call. We have a really great offer for your audience, Mark, for the Power Play. We definitely want to make it as accessible for your audience as possible. I know we have some deals working on the other side, but I want to be able to offer, a special promotion for anybody listening who does want to take action. So we're offering 50% off actually for all of our setup fees for anybody who uses the discount code PowerPlay50. So if you're looking to get started and you've had cold feet in the past, and that initial setup fee has been a barrier, use coupon code PowerPlay50, and 50% off is no joke with the setup fee.
Oh, I really appreciate that. I like that.
Yeah,
So
absolutely.
So again, why don't you, for the listeners, if anybody's driving, what's the best way for them to contact you or wherever they need to go? But we'll also post a link below. But what do you think? Where's another way of how people can reach you?
Yeah, for any of you driving, keep two hands, 10 and 2, eyes on the road. But if you do want to learn more, go ahead and search IRA123.com. That's the domain for Safeguard Advisors. Again, that's IRA123.com. Feel free to look me up on LinkedIn, Nick Sahagun, Sahagun, Nick Sahagun. I'm on LinkedIn. Feel free to message me. But yeah, quickest way to get some time, some FaceTime, or I guess talk time with me on the phone, is go to IRA123.com. Schedule some time on my calendar or use the link below.
Yep. I really appreciate it. All right, guys, this was another great episode. Thank you guys so much. And I highly recommend you guys get this set up. It works great. It's going to save you a lot of headaches. And then as you grow and you start educating and you've done this yourself, it's a great way to raise capital through your friends and family. If they have IRAs, you can hit them up. And this is a great way to raise and kind of scale your business, because you have a lot of friends and family in your network that are not even aware that they can use their IRAs and their 401ks, that they can invest in these projects with you. So, and if you want to know more about that as well, go ahead and just book that call with Nick, and Nick can kind of help you with that process. All right, guys, thank you so much for another episode of Real Estate Power Play. Nick, thanks so much for coming on.
Always a pleasure, Mark. Thank you again. We'll see you, everybody.
See you guys.